Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The illusion of precision in financial planning. Most comprehensive financial plans are elaborate exercises in fortune telling. Talk to any financial planner or use an online one, and you'll eventually get a document almost like the Union Budget's explainers. There will be dozens of pages, color-coded charts, projections stretching decades into the future, and calculations precise to the last rupee. Your retirement corpus? 14,73,82,456 rupees. Your child's education fund in 2041? 1,67,23,891 rupees. The monthly SIP required to achieve financial nirvana? 63,847 rupees. It's all very impressive, very scientific, and almost entirely meaningless. These elaborate financial plans are the investment industry's equivalent of the emperor's new clothes. Everyone pretends they're marvelous because questioning them feels like admitting ignorance. But here's the uncomfortable truth. Most comprehensive financial plans are sophisticated exercises in fortune telling dressed up in the language of maths and analysis. Consider what these plans actually claim to know. They confidently project inflation rates for the next 30 years, assume your salary will grow steadily annually, and presume that equity markets will deliver exactly 12% returns, while debt funds will provide precisely 7%. They factor in your child's marriage expenses in 2045 and calculate your healthcare costs in retirement with mathematical certainty. The sheer audacity of these assumptions would be amusing if people weren't making life-altering financial decisions based on them. The reality is rather different. Nobody predicted the 2008 financial crisis or the AI boom now threatening to transform entire industries. No one predicted the geopolitical upheavals that are happening now. Most people's actual financial journeys bear little resemblance to the smooth trajectories their plans anticipated. Jobs change, businesses fail, opportunities arise, health issues emerge, and markets behave in ways that would alarm every spreadsheet genius. Yet we persist with this charade of precision because it provides comfort. There's something reassuring about seeing your financial future mapped out with apparent certainty. The problem is that life doesn't follow spreadsheets, and the most important financial decisions are often driven by events that no planner could have anticipated. What's particularly troubling is how this complex theater often obscures rather than illuminates. The average investor emerges from a planning session with less clarity than when they started, overwhelmed by jargon and paralyzed by the apparent complexity of managing money. They're told about asset allocation models, rebalancing frequencies, and tax optimization strategies when they really need the confidence to start investing regularly. The irony is that the most successful investors typically follow remarkably simple principles. They diversify across asset classes, invest regularly regardless of market conditions, avoid taking on excessive debt, and maintain adequate insurance. These basics haven't changed in decades and don't require complex calculations to implement. I'm not saying that all financial planning is useless. Setting goals, understanding the basics of different investment options, and calculating how much you need to save are genuinely valuable exercises. But there's a vast difference between this practical guidance and the elaborate projections that dominate most financial documents. The real value of financial planning lies not in predicting the future, but in building flexibility to handle whatever the future brings. This means focusing on habits rather than targets, maintaining emergency funds for unforeseen circumstances, and keeping investment strategies simple enough to understand and adjust as life changes. Perhaps most importantly, it means recognizing that financial planning is an ongoing process, not a one-time exercise that produces a document to be filed away. Your 30-year-old self cannot possibly know what your 45-year-old self will want or need. Plans should be living documents that evolve with your circumstances, not rigid blueprints that assume life will unfold according to schedule. Instead of seeking certainty where none exists, We should focus on building the financial habits and flexibility that will serve you well, regardless of what the future holds. That's a plan that might actually work.